If you are retired, or if you are anywhere near handing in those keys and stepping into your golden years, there is a dangerous lie being told out there, and I need you to wake up to it right now. Let me tell you what happens when you let your credit score fall off a cliff just because you paid everything off. You go to downsize into a lovely apartment, and the landlord runs a credit check and suddenly demands a double security deposit or turns you away completely. You go to shop around for auto insurance or homeowner's insurance to save money on your fixed income, and guess what? They use your credit score to price your premiums. Lower score means you pay hundreds of dollars more every single year for the exact same coverage. Or, heaven forbid, an emergency happens, or you need to finance a new HVAC unit for your home, and because your credit profile has gone ghost, meaning you have no recent activity, you get hit with predatory interest rates of 25%, 28%, or 30%. That is a nightmare when you are living on a fixed income. You cannot afford to lose your hard-earned retirement nest egg to high interest or ridiculous fees just because you stopped using credit. So the question becomes, how on earth do you build, maintain, or rebuild a rock-solid credit score in retirement without getting into debt? How do you do it without getting a high-interest credit card that tempts you to spend money you shouldn't be spending? What is Kikoff? How does it build credit, and is it safe for someone in retirement? I am going to break it down for you right now, step by step, so you are safe, sound, and secure. First, let's talk about how Kikoff actually works. Kikoff is not a traditional credit card. You are not getting a piece of plastic in the mail that you take to the grocery store or the gas station. It is a credit-building service. When you sign up for Kikoff, they set you up with what is called a revolving line of credit, starting at $750 for their basic $5 a month plan, and going up to $2,500 or $3,500 on higher plans. But here is the critical part you must understand. You cannot spend that $750 anywhere you want. You can only use that credit line inside Kikoff's app to purchase small digital products, like financial educational guides, or to cover your monthly membership fee. Now, why would you want a $750 credit line that you can't spend at the department store? Because that is the whole point. It removes the temptation. For retirees who are terrified of getting into debt or getting trapped by revolving credit card interest, this keeps you completely safe. Here is the magic behind how it moves your credit score. Your FICO score, the grade that lenders and insurance companies use, is made up of 5 main factors. The 2 biggest factors, making up a massive 65% of your score, are payment history and credit utilization. Factor number 1. Payment history makes up 35% of your score. Every single month that you pay your $5 Kikoff plan, Kikoff reports an on-time payment to the major credit bureaus, Equifax, Experian, and TransUnion. Month after month, tick-tock, you are building a spotless paper trail of 100% on-time payments. Factor number 2, credit utilization makes up 30% of your score. Credit utilization is the percentage of your total available credit that you are using. The credit bureaus want to see that number below 10%, ideally as close to 0% as possible. If Kikoff gives you a $750 credit line and you are only using $5 of it each month, your utilization rate is under 1%. That looks absolutely beautiful to the credit bureaus. It tells the system, this person has credit available, but they are disciplined and not desperate. There is no hard credit check to open it. When you apply for standard credit cards or loans, the lender does a hard inquiry on your credit report, which temporarily knocks your score down. Kikoff does not do a hard credit pull. You sign up, they verify your identity, and you get started without taking a single ding to your score. There are no interest charges, no late fees built to trap you, and no hidden surprises. Plus, for those of you who are renting in retirement or planning to rent, Kikoff has features that let you report your monthly rent and utility payments to the credit bureaus as well. Think about that. You are already paying your rent, your electric bill, and your water bill every single month on time. Why shouldn't you get credit for the money you are already spending? Now, listen to me very carefully, because you know I am always going to tell you the truth. Kikoff is a wonderful tool, but it is not magic, and it is not for everybody. If you already have a 780 or an 800 credit score because you actively use a credit card every month and pay the balance off in full, you do not need Kikoff. You are already doing what you need to do. Kikoff is specifically for 3 groups of retirees. Number 1, you have thin credit because you haven't used credit in years and your score is dropping or disappearing completely. Number 2, you had a setback, maybe medical bills or a bad financial situation a few years ago, and your credit score is in the 500s or low 600s, and you need a safe way to rebuild. Number 3, you want to boost your score before applying for a new lease, auto loan, or insurance policy, and you want to do it without taking on credit card debt. Here is your actionable takeaway if you decide to use Kikoff. Step 1. Go with the basic $5 per month plan. Do not feel pressured to jump into higher tiers unless you specifically need the extra credit monitoring or rent reporting features. $5 a month is $60 a year to protect and rebuild your financial reputation. Step 2. Set up autopay immediately. I mean the very minute you set up the account. Because if you miss a payment on a credit building account, you defeat the entire purpose. A late payment will hurt your score, and we are doing this to protect your score, not hurt it. Connect it to your checking account, let the $5 auto draft every month, and let it run in the background. Step 3. Give it time. Credit building is a marathon, not a sprint. You will likely start seeing positive movement in 2 to 3 months and significant improvement over 6 to 12 months as that on-time payment history stacks up. Stand tall, protect your money, keep your credit score strong, and never let anyone tell you that credit doesn't matter in retirement. You've worked too hard for your peace of mind, now go secure it.